Hi everyone, welcome to our Know Your Numbers webinar. This is basically for business owners just to get to know a bit more about your numbers and we'll talk about 6 different reports through. There will be Q&As at the end, so save them up, put them in the Q&As as you go along as well. It's going to be about 45 minutes. This is one of the longer ones normally, just because there's numbers in there and it can take a little while for me to just go through everything. So hopefully if you've got any questions, just save them up to the end. So that'd be good. So I'm just saying welcome again. I am an accountant. I have 2 businesses, but I have Naylor Accountancy Services. And one of the things that we're looking at doing within Naylor Accountancy Services is helping business owners understand their businesses more and also enabling services around that to help them. One of them is the webinar. So these are obviously free for everybody. These are on YouTube as well, so you can relook at it at the end if you want. We will be downloading it and sending it off to people as well. So that will all be available to everybody as well. If you wish to share it or anything, and if you've got any questions after this, just send them our way and we'll get back to you as well. So the webinar schedule that we've got, I'm just sharing this with you just so you're aware. We have got a whole program for the next year already. These are just a few of them. So we're doing Know Your Numbers now. In January, we're doing the 3 essential tools for business success. That is a really good one, especially for the start of the year for everybody, just to understand what they want to be looking at, how it might be useful for them. Then building a better business, then getting paid, which is more cash flow, and then boost your business wealth, and then reclaiming your time. There will be other ones in as well after May. So they're all on our website. They should also be on our LinkedIn at Naylor Accountancy Services LinkedIn. There's under events. They're also under events under about us in the website as well. So do look out for these if you think it's useful to you. So just do book onto them, or if you know anyone else that might find them useful. So a thought for the session. I always like to start with a thought. But obviously, budget is not just a collection of numbers, but an expression of our values and aspirations. So that's the budget. So hopefully you understand a bit about your numbers. This will give you a bit more information on them. If you don't know anything at all, it will help you. Then you might want to go back over the video as well, because I will be having to go through it at a fair pace, but hopefully it will give you a good insight into that. Now, so it's just time to make sure you can understand, monitor, and measure what's set in your budget and forecast as well. So this will sort of help you do that as well. So the webinar, it's not about it's about sort of demystifying the most common sort of reports that you have in the business, and that you might be seeing weekly, monthly, quarterly, or just even on an annual basis. And it just gives you more control of your business because you sort of see them and understand them. So the agenda. So why you need to know your numbers. So we'll be just talking a bit about that. Then the overview of the 6 reports. So there's 6 reports that we'll be going through. The difference between profit and cash. Now, that's a really big thing, and it's something that we come up on a lot in our accountancy firm, is that business owners don't always know what the difference is. They think, oh, I've made a big profit, so where's the cash? So the issue there is obviously you might have a big profit, but not cash, and we'll go into the reason why that might be later on in this. And then also you could theoretically have a lot of cash and not much profit just because you've got a big loan. So you've got a loan or something, but we'll talk more about that as we go through. The key drivers of business value, we'll talk about a few of those. Oh, sorry. And then there's just to protecting your assets, a few ideas on how you can protect your assets and what there are that you can do. Adopting best practice, and then some next steps that you can take. And then questions right at the end. So save them up, put them in the Q&A, and then just let me know what those are. So Why do you need to know your numbers? So it just tells the story of your business. So with the numbers, it actually tells you and interprets the results of your business and activity. It also just helps with identify symptoms um, and root causes of, for example, if you've got a decline in gross profit, it might be a symptom root cause of ineffective pricing. You might not be pricing correctly, or someone might not be, or rework that you're having to redo, so you're doing it for free, or per purchasing, and just wastage, time wastage, asset wastage, things like that. And then knowing your numbers, it's also going to enable you to spot early warning signs of potential issues. Just for example, like monitoring how long it takes customers to pay you, it just allows you to quickly respond to if the numbers start to increase. So the more people. So it just gives you a warning sign. And it also gives you areas of strength and weakness. Basically, so on your balance sheet, so it indicates whether your business value is going up or down. So it just has a very quick indicator of a business strength or weakness. And that's what credit rating agencies use as well, and support better decision making. That's a key. So it can actually help you make decisions, and also with your forecast and everything, you can do investment that will drive, say, your sales, and then that will increase your different figures within your reporting as well. And knowledge is power. So we say knowledge is power, but if you don't have action with the knowledge, is futile. So knowledge is power, but action is the way it happens. But knowledge is power. So you need to know what's going on as well in your business. But obviously you need to take action if there are issues, especially. So overview of the key reports. It's a trading account. So that's effectively the first thing we're going to talk about. And then your profit and loss account, balance sheet, which is like a snapshot at a certain time, a statement of change in equity, and then we're going to talk about the depreciation schedule, effectively your asset register, and director's current account, which is your director's loan account, and then those are the 6 reports we'll be talking about. So I'm going to start just with a trading account. So the trading account, that tracks your sales, variable costs, gross profit, and calculates the return that you're going to be achieving from deducting your fixed overhead costs. And the gross profit percentage indicates whether your margin is improving or deteriorating. So, and also you can sort of track your results across different divisions or product lines by using sort of a multiple trading accounts. Just for example, like you could have a regional location. So if you have different offices, you can have those different regions there. And just tracks that for me. And you can do small adjustments. They can have like huge impacts on the overall impact of the results, basically. So it can sort of just demonstrate that, which I will demonstrate now, basically. So this is your trading account. So effectively what we've got here is a fictitious food manufacturing company trading account. So when the trading account is basically the revenue and the cost of sales. So we've got all the direct costs in here. So you can see it's making £1 million, just over £1 million a year. It's got a total cost of 318, cost of sales, and that gives a total direct cost of £450,000, and that gives you a gross surplus. So that means you've got excess, so you've got a gross profit of 250, so £248,000, and that gives you a gross percentage margin of 24%. So that all sounds good. So you've got a good one there. However, it may not be good when you look at the rest of your numbers, which we'll come to shortly. So just if you wanted to improve this, so let's just say that you undertake sort of some coaching with an accountant, which we can do and other people can do as well, but and implement some strategies just to increase the customer retention, as resulting just literally in a 10% increase in your customer retention. In sales, so you because you're not losing 10% of those clients, and then you also look at the cost of sales by reducing it by 5%. So you can see I've just highlighted that there. And then also your direct costs, you just look at how you can, you save yourself 5% on that as well. So that all equates to basically a saving here, a difference of 22K. So you've got a saving of 22K. So that basically indicate, oh, so 140, you have a gross, yeah, you save 22K on your direct costs. On your cost of sale, you're saving 15,000, and you've also got the increase in sales of 104. So overall, you've got 389,000, which is 35% increase. So that's 140,000 pounds extra. That's from just increasing sales through retention of clients, so 10%, lowering your cost by 5%, and lowering direct costs. So you can just see, just by doing the percentages on these numbers in the trading account, it can actually have a big impact. And again, what happens if you start having a plan and a goal and you're looking at all this, things happen, you actually start moving down that route. So you actually do what's required on that. So that's what happens there. Now, if you look at, I'm just going to the next one. So, oh yeah, I've talked about these, so 35%, so there. So if you look at the profit and loss account, it can also be known as the income statement, but that shows all your earnings and costs over the year, and it tracks the overall, basically, performance of the business. So I should be saying or over the year. It's what we sort of all can see in the cloud accounting. So if you have cloud account QuickBooks Zero, you can do a report in there very easily. And if you are with us and you're not sure how to do that, just ask your client manager how you can actually do a report, or anybody in the team, how you can do a report of profit and loss. It's actually well worth looking at on a regular basis just to see where you are. So it just matches income and expense. And it just provides a framework to benchmark everything, so you can actually see what's actually happening. And it's very useful. It's the one thing that we all look at as accountants. When we have a meeting or anything, we'll definitely be looking at the profit and loss. And it's a fundamental driver of business value. And I say that because if you are looking to sell your business, now what they look at is your profit. They take out a few other things, but you look at your profit and do a multiple of that. And that's what the value of your business is. So that could be, depending on the business, between 3 times your profit to 12 times your profit. That's the value of your business. It all depends on lots of different things. But that shows the value of your business if you're wanting to sell or in the future. So here we have our example of the fictitious food manufacturer. So you can see here we've put in the gross profit margin at the top of 248, which was the original one before we did anything. And then we did the changes that we were looking at. So you can see there that we've got then, but if we now look at different things that we can do, so you can see here just that we've got, oh, I'm going to go back, sorry. So you can see that we've got a net loss of 113,000. So that 113,000 there, that's a net loss, so a net loss. So even though we had a gross profit, which gave, what's that, 24% margin on the gross profit margin, we've still got a loss because we've got all these costs here in there. So what we'd want to be doing in this case is you need to do something, because if you keep having a loss as a business owner, you've not got any business that worthwhile having, because you're not going to make any income. So you're not going to actually earn any money from it. You're going to be actually just paying salaries if you've got people on salary and working for their salary and not actually doing anything for yourself, unfortunately. So we would want to be looking at this in more detail and what we can do. So just here, just a few very quick little ideas. So one is that you can look at just decreasing, having a conversation with your insurance people, having your accountant or whoever, talking to them, and then you're lowering your insurance by 5%. And you can also look at your rent and renegotiate your rent, say that goes down by 5%. If you do that, you then have you have saving of £597 on your insurance here. then you also have a rent of 2,800 that you would save. You would also have, if your accountancy fees were in here, so you say the accountant was doing the work for you, you'd have a cost of your coach or your accounting on that. So you'd still have a loss here of 2,000 here, but overall you would also have the improvements that we talked about before, where you have an increase in your gross profit margin to 389. So that gives you 140,000 on your gross profit. So that gives you a net profit of 138, despite the extra costs in the fees, but you've also got loan on insurance and your rent. So it's just showing you have to, if you are doing any actions with a coach or accountant or anyone like that, you will need to pay something out, but it's worth it if you've got basically a plan there and you're looking at your numbers. Make sure the numbers are what you want to be working on, and then you work towards that goal. If you have a goal in mind, you tend to always be going towards it, and it actually does normally come to fruition. So balance sheet. So that's also known as the statement of financial position. And the reason for that is basically just a snapshot of things at a specific point in time. If your year end is the 31st of December, it'll be a snapshot at the 31st of December. If you do have online cloud-based, which we all do in our practice, is QuickBooks or Xero, you can have this as well. This is live as well, so you can always see this. So on the balance sheet, it's basically your net worth for the business at any point in time. So which is your assets less your liabilities. So, but it basically shows if you solve them, because if you have more liabilities than assets, you are insolvent because you need to pay creditors. So that might be loans, it might be creditors, so trade creditors, people need to pay and all that. There may be more payments that go out with tax, basically. And the comparison periods is possible within a balance sheet, which is always useful because it shows if your business is strengthening or going down, or you need to be relooking at things. Credit rating agencies do look at balance sheets, and this is what everybody has to put into the company's house. Now, there are potential that we might have to do profit and loss into company's house with the new rules that might go through and some of the legislation, but that's in the future. At the moment, it's just balance sheet. So that's that. A basis for calculating key ratios. So we do use this to calculate key ratios like debtor days, and we'll do that in a minute, and we'll explain why that's useful, and inventory days. So here we have our fictitious food manufacturer. So as you can see here, the company is currently insolvent. So you can see, oh, I'm sorry, I don't want to carry it there, but at the bottom there, it's got net assets of 304K, but you've got total current assets 138K, and you've got current liabilities 162. So you've basically got more liabilities, current liabilities, than assets. Current assets. Current just means it's something that has to be paid within the year, theoretically, or you're going to get back within the year. If it's long term, then it means it can be a 10-year loan or something like that. So you'd only do the 1 year of that loan that needs to be repaid as your as part of your current liabilities. So assuming this is the company can sort of resolve these urgent solvent issues, as in it's not going to just collapse because of this. There's other areas of improvement that we can look at straight away on this. And one of it is just the long term is implementing strategies to reduce debtor days and inventory days. So what we'll do is we'll just look at debtor days first. With debtor days any of you guys can do this on your own balance sheet. You just look at your debtors on the balance sheet, divide it by the sales. So that's like your income, your total income, and then times whatever that division is. There should be brackets around that, debtors and sales. Then times that by 365. That 365 basically is the number of days in a year apart from a leap year. So you do that, and that gives you the number of days debtor days, and that's 26. So what that means is it takes 26 days for people to pay the bill. Now, if you want to improve that by 5 days, what that will do is increase your cash coming in. It doesn't improve your profit, but it improves cash. So it just means you've got more cash in the bank. So, but if you improve that by 5 days, say that's 5 times the debtor, the sales over 365, that's 13,944. So £14,000. So you would get an extra £14,000 in basically quicker with that. That have an additional £14,000 on your cash balance, basically. So it's definitely worth looking at that by just changing your terms of trade, say, on that. Then inventory, so that's worth looking at. Inventory days. So inventory days, that's inventory, which is the same as stock, guys. So it could be stock that you call it, not inventory. And then do it on the cost of sales. And then times that again by 365, what that is. And that's the number of days again. And that gives you the number of days it takes you to sell what you have in stock or in inventory. And in this case, it's 74 days. So you've actually had to purchase the assets. You keep them there, you create the product, and then you're actually selling it 74 days later. But it means you have to outlay your cash first. So if you can improve that, again, if you can improve that by 9 days, so that you don't have stock for 9 days, you sell it 9 days quicker, or you don't get the stock in until 9 days, but you create, you're actually able to produce the process quicker, then you would have an extra 7,860 in cash, because you're not tying that up in your assets and you're getting paid quicker. Yeah. So that gives you an extra, let me just go back. So that gives you an extra basically 22K of, where am I? 22K. But it doesn't fix the solvency issue, because you're only getting £22,000, but it does demonstrate how much cash could be saved with someone just helping you, just like your accountant or coach, someone. So you're just helping you, just looking at it, at your numbers. Your statement of change in equity. So this just basically, this is one of the other reports. It shows what happens to the profits. Now you can see this on your accounts that you have, annual accounts. It just shows if the profits paid out as dividends or retained. When it's retained, that could be for reinvestment into the business, so you've got cash, or you might just be retaining it because you don't want, the owner doesn't want to pay the higher rate of tax, and they're just keeping it there till another day, just as a rainy day, instead of just reinvesting it and then taking it out later. And it just also represents like the net worth or value of the company. And it's just a key indicator of the company financial health as well, because if you have got like a net positive, that's great. And that's what we always want for our clients, always. Even when you take out a dividend, we want to leave a credit in this. And the reason is credit ratings look at it. And also we want you to be able to take dividend next year. So if we can leave a little bit in there, in case there is an issue on the profits, we can't get as much profit, or you can't get as much profit next year, you can still take a dividend. And and it just means that you are solvent as well. And it it shows that it's solvent. So here you have just a very quick statement and a change. So the company it's accumulated losses. So you can see the total equity is 305,000, and it was 191,000. So it's been accumulating losses. And the opening balance of 2019 just on here. So it's been doing it for at least 3 years, because that was brought forward 139K. So and you just constantly, you can't carry on like this. If you keep making a loss, it's not going to help you as a business owner, because you're not going to be able to earn anything apart from maybe you've got salary in here, but it's not going to be a solvent business, because there's no money to pay out dividends. And you can't pay out dividends until this total equity number here, here, the 305 is positive again. Once it's positive, you can do dividends. So you wouldn't be able to do that. So there's no money to pay out for dividends, no money to reinvest in the company or purchase new assets. So the directors have to take action now to increase the profitability of this company, because that's the only way they can increase that total equity. So this shows a business that needs help, basically, or it's going under. So director's current asset. This is the director's loan account. With this is basically the running record of the funds that the owner, business owner, you have introduced to the business from whenever you started the business, and then also monies that you've actually taken out as well. So it's in that personal expenditure. So we don't like people taking money out of their business accounts personally, apart from moving it into their personal account and then spending it there. So so you just go straight out as a director's loan to their personal bank account, and then they pay it from there. But it shows that coming out. But this needs to be monitored and ensure the record of that there isn't a negative, because if there's a negative, there can be a negative, but then we need to have enough profits to be able to do dividends to pay it back. Because otherwise, what happens is there is an issue which we'll go on to in a bit. And it just shows what the director owes to the business and what the director is owed by the business. So it can go both ways. And if the director is owed it by the business, that can be taken out of business tax-free at any time. So here we have an example. This is Mr. John Doe, and he has 29k opening. So he had £29,000 at the start, and then through that he's introduced funds of 2,000. So that's probably like home office, travel, potentially gone through. So in an accounting entry, and it's gone to his director's loan because he didn't take the money out. He's just credited it, or this bookkeeper has. And then decreases. So this is money he's taken out. So he's here. So that's £9,000 that he's taken out in loans and personal expenses through this. So, and then he's ending up with a net director's loan current account of 21,870. That's owed to him. So he can take that out at any time, tax-free, 21,830. So if this is overdrawn, we have a problem. So what we'd be looking at as accountants, we'd be looking at dividends to pay it off. That's what we always do. If there's not sufficient profits to pay the dividends, we'd be looking to have that paid off for the next 9 months with profits in the business after the year end. If we can't do it after that nine months, then the company has to pay 33.75% tax on the actual amount that's overdrawn 9 months later. Now that is a cash flow issue because you're going to have to pay it out. You do get that money back, but only once it's all the director paid it all back, and there's a timing difference, and there's also if it's over a certain length of time, you can't get it back. This is not something you really want to be doing, and we always look at all our clients to be within their director's loan amount that they can actually pay back in dividend, because if you don't, then we have issues that we need to resolve as soon as possible, because we want the director to repay them. Fixed asset register. So this is basically also known as a depreciation report. It's a register of all your assets in the business. So from PCs, vehicles, plant machinery. If you do have property in here, we'll go through that later, because I would never have property in your business. If you do, just wait till we talk about protection. I wouldn't have it in it, but for a very good reason. Facilitate spread of the cost of assets. So what it does is that it spreads it through depreciation rates, which can be reducing a straight line, and it does that over a period of time. And it just means that the profit and loss isn't going up and down, up and down. So if you go in and buy a an asset that's going to last you 10 years, rather than your profit just going down loads and that the first year that you buy it, it'll just be spread over those 10 years. Now, that's if it's a big asset. PCs and stuff, we normally do over 3 years, but you can do it all in one go as well. And then basis for keeping track of your business assets. It's where you should have all your business assets. I would recommend, if you have business assets, just have a numbering system for them all as well. So you have it on the back of your PCs, everything like and then have it on your asset register so you know where the assets are. If you've got a lot, if there's not many assets, as long as you know if it's just you. But if there's other assets, I would definitely do that so you know who's got them as well. And it's also a useful guide for that annual asset replacement of the budget. Now, it's not 100% because it's not the value of those assets, but what you do have is the cost that you paid at the start of it. But the actual net book value isn't necessarily what it costs you to buy one, but in the future. And it's helpful for selling the business because you know what all the assets are. There may be a value to those assets as well. So you may be able to sell those assets on when you come to selling the business. PCs, you don't normally get any value from at all when you sell a business because, everyone says it's a 3-year life. So then normally just go with a business sale. But if there's any other assets that you do have, especially vehicles and property or other big assets, then it's definitely worth, it's on there and you'd have a sell value of them. So here again, we have our fictitious company, and what we've got is just this is just all the costs. So these are all the costs of the van, the car, everything that was purchased, software. So these are things that are purchased, a one-off cost, and when they were purchased. Now here is the opening net book value. That is at the beginning of the year. So you have a depreciation, you'll see that in a minute, that comes off the net book value. It's cumulative over the years and life of that. And that's what the net book value is, that will then get depreciated in the current year that you're looking at. So you'd add in all the purchases that you do in the year. So here you can see there was a purchase of a website, as in the cost of the website. So you're depreciating that over time. And then the security camera system as well. So those added in, that's an extra 16,000. And disposals, there was only a few disposal, like computer. You can see it's next to nothing. So the disposal, what that probably just means is it wasn't sold. It just means it was got rid of, because all you're doing there is doing the net book value exactly the same. So they'll have just been got rid of. And you've got and plant and machinery, you had trays. So you sold your trays for 3 as well. So that just gives you that 20 on disposal. So these are just basically items that have just done their life and they've basically been thrown out. So theoretically. Then you have your rates. So these are the rates of depreciation. All of these are different rates. You've got 30, you've got 6% on software. So you've got all these different rates that would then be charged on the opening net book value plus the purchase. So, and this is a reducing balance method. You also got straight lines. That's just a straight percentage on it. A straight line just means, say, if it's 3 years, whatever the cost of, if it was £3,000, you'd do £1,000 for each one of those years as depreciation. And here you got the depreciation calculation. Excuse me. And that's your closing accumulative depreciation. So what that means is all the depreciation you've done in the past, and I apologize for this one because this is a bit mathematical, all this, but it is all of these, including the new depreciation just next to it in the row there and next to it. And then that's all then. Then what you do is you get your closing net book value, which is this. There's the cost of the goods, original goods, including the cost of your new purchases, and less the cumulative depreciation. So that means you've got a net book value now of £268,000. So I couldn't see it on my screen. So that's what the value of your net book value is at that point in time. So to just sum it all up, the the key report, oh yeah, and just very quickly, I haven't sort of gone over this, but with assets, if you buy an asset, you in the UK, what we do is have annual investment allowance. It's £1 million. So they were going to change it back in 2022, but they didn't because of COVID and everything that was going on. They wanted people to reinvest. So it's £1 million. So you can buy up to £1 million of assets in 1 year, and all of that can go off against your tax. So it goes as a credit against your tax. It doesn't hit your P&L apart from under depreciation, which is what you would see here. So that means that if you don't use all of that as well, so you might have a tax of 0, so because you might take out all your tax for that year, then you can carry that forward to the next year. If it's more than $1 million, then we still use it, but it's a different method for the stuff above £1 million. But it's just so you know, any assets you buy, obviously that lowers your cash. It doesn't have a big impact on your P&L apart from depreciation, but you also get a tax credit as well for it. So that's something that we would always talk to you in your annual review meeting, just to explain that, because you might have a lower tax bill because of it. It doesn't mean you should go out and buy loads of assets if you don't need them, because you still have to then pay out the cash. Only if you need it, do purchase them. So the 6 reports. So the first is the trading account. I'm just going to the profit and loss account, the balance sheet, the statement of change of equity, the director's trading account, and this was the last one, the fixed asset register. So we've sort of just gone through all those. I know it's gone quite quickly, and there's a lot more we can talk about them, but we're trying to fit it all within the time frame that we've got. So what I'd say, we're just going to go on and talk very briefly about the difference between profit and cash. So like I said, a lot of business owners have frustration that their bank account doesn't seem to reflect what's in the profit. And that's 100% true. It doesn't. So profit, as they say, well, turnover is vanity. That's what they say. And then profit is sanity. So obviously you want to have a profit because it shows it. But always you need cash to survive. If you don't have cash as a business, it doesn't matter if you've got high profit. And we'll come into the reasons why you might not have have cash, even though you've got high profit. But cash flow is the reality. So in other words, cash is king. And that's what you hear all the time. Cash is king. You need access to funds to draw on, to do anything, to pay your salaries, to pay for goods, and it's also to pay you, so you can live as well. A big thing you see in business owners is what we call entrepreneurial poverty, in that they don't always have a profit or enough money for themselves. They're paying all these things, lots out. What we do see is some businesses downsize because of it, especially in the trades, because it's very difficult to manage it. And then they earn themselves better profit if it's just them. But if you can manage it, manage your numbers, you can make more money from other people working with you, because they can do it whilst you aren't actually doing the work, or other people, or doing other things which might generate you other income. So this is just to demonstrate the difference between cash. Okay, so with profit, interest on loans, you paid out, so it would be a cost, but you'd also impact your cash as well, because your cash would go down, the interest you pay out on loans. So it has impact on both. Depreciation. Now, depreciation only has one impact, and that's on profit. Now, that's just an accounting entry. Obviously, if you're buying assets, then that has an impact on the cash, and we'll get to that in a minute. But if it's assets you purchased in the past, you'll still have a depreciation in there, but it won't impact your cash any further because you've already purchased them. But it will have an impact on your depreciation. So that could lower, these two could lower your profit, basically. VAT affects your cash, because you might think that this cash is mine, but you're not. You unfortunately are collecting that tax for HMRC, so at the 20% rate, or whatever the rate is, if it's a lower rate. But that 20% is owed to the tax man. you have to pay that out every quarter. Now, we always advise, if you haven't got this, I would advise you do it straight away. Have your own bank account just for that, and put the VAT in every time you get money in, put 20% in, because that is the VAT man. Obviously, you'll have offsets against it, so it's not always 20%. It depends how many offsets of inputs of purchases that you have, that VAT you can take off it. But that VAT is the VAT man. So this is what we have a problem with some of our clients, in that they think it's theirs, or they actually use it as a safety net, the VAT, which you have a quarter between you pay it. So you might have a little bit of a leeway there, but you've got to be careful when you do that. So you really must know it. And the best way to know what you owe the tax man or the VAT man is by having a separate bank account. Loan repayment. So if you have a loan and you pay it back, it doesn't impact your profit, but it definitely impacts your cash, because you've got to pay that loan back. It's good because it lowers your interest on the loans, so it will lower the amount that you pay out. But if you pay 100 grand back and it's 3%, you'd only be having £3,000 a year saving in your interest on the loans, but you're actually paying out 100,000, so you're 97 grand worse off in cash, basically. That's just a very quick example. Interest on loans, like I say, that would have impact on cash and your profit and loss. That's only the interest element, not your repayment element. So with bounce back loans, which lots of you may have, those bounce back loans have an element of repayment and interest. So every year you will have a different balance. So if you took account the full 50K, it should be around 26, 25K now. And then the rest will have been paid as repayment on the loan, and it would have been on an annual basis. So that would actually should be going down in your balance sheet, and then obviously your cash, but your P&L would only reflect not the 25K that it's gone down by, it would only reflect the interest element of that. Hope that makes sense. And then asset purchases. So I've alluded that throughout this. If you do an asset purchase, it's going to hit that cash, but it won't hit your profit. We'll do the depreciation, but that's only potentially at 30% rate. You saw the different rates in your asset register. So you'd only get that on an annual basis for however long you keep that asset, so 10 years or whatever. And then, but that asset purchase hits the cash straight away. An asset sale. So if you have an asset sale, that won't impact profit unless you do make a profit above whatever you've taken in capital allowance. But that will impact your cash, because you have a positive cash flow coming in. But the big one, if you have a high profit, say, or a profit and no cash, is potentially that you've been purchasing assets or paying back loans. That's normally the main one. So this is a lovely example. It brings everything together, this. So I love this. It's the business one-on-one cycle. And it just, there's a difference between cash and profit, but it shows everything. So here, you invest money as an owner. You always do normally at the start, and you might do it throughout. Then what you do is you use that money to create assets. That might be your services, whatever, or generating a product. That involves income. And you might need a loan to just put in it to create those assets as well, because you may not have enough investment money for yourself. And then that creates the profit, so return on your assets. Now, this is before you've got cash. So the gains on that are, the profit gains, you've got sales growth, and you've got margin growth in there. However, there are drains, which we sort of talked about as well. So, and they are basically, unchecked overhead expenses. So like we said, look, if you're looking at 5% changes here and 10% there, whatever, that has a big impact. So you just got to be careful on your overheads as well. Cash. So the cash generating that comes out of your profits and your invoicing. So that generates it from the business activity. But the drains on that, there can be drains on it, which we've sort of discussed as well. And the main ones there are, oh, can you see that? So I'm just moving. Our slow collection of debtors. So that's the big one that we've spoken about. So we can look at collecting it quicker. We talked about, I think it was 9 days quicker, and inventory, or 5 days actually quicker. And then it was 9 days on inventory. But increasing in what it was in stock or work in progress. That's another one. And then you've also got the business tax payments. So when you're paying tax out, that goes out. Corporation tax impacts it. VAT, obviously, but I would keep that in a separate bank account. And faster payment of suppliers. So you might be paying them fast, your suppliers. So that's a drain. So you might want to be slowing down payment if there is an issue with cash. Gains on it, you've got basically the gains are I'm going to have to look over here, but faster collection. So you collect faster, which is what we spoke about. You've got decreased in stock, which makes it a lot easier as well. So you don't have to, like we spoke about, if you do it for 9 days, it would give you 13 grand extra in our example, but that just means you're not using the cash to buy stock for as long, and that's sitting on the shelf effectively, so you're selling it quicker, or you're not buying in the assets as quickly. Slower payment of suppliers, that can help the cash obviously as well, and reduce tax payable. So obviously look at your tax burden and lowering that as well. So that's all drains and gains on your tax. Now, owners, as business owners, you take drawings out and also have personal loan repayments. So you would be paying in as well. So the idea there is that as an owner, you want dividends. So you take the money out, you'd have dividends, and then you might be also repaying your loans, as in the loans that you put in at the start. By accelerating this spin of the wheel, you increase your return on investment. So the key is have this working, know what's happening, and then speed it up. Now, when I say speed it up, that means like debtor days lower, inventory days lower. So you've got your cash moving forward quicker, and as well, and then just everything, you're not holding stock as long, you get sales in quicker, everything moving quicker. That will improve this. So this is the business 101 cycle. So assets to profits to cash to owners, and you've got your drains and gains on that as well. So the key drivers. So after cash flow, business value is the next most important measure for a business success. And part of knowing your numbers is just sort of understanding and measuring the drivers from the business value. Now, they are different for every business, but you've got examples of these drivers. So it's that monthly recurring revenue. That's why I say it's always worth looking at your P&L, your profit and loss, and your balance sheet, but your profit and loss on a regular basis, at least monthly. If you've got QuickBooks Xero, you can look at them all the time. The key on looking at it is your bookkeeping's up to date. If your bookkeeping is not up to date, your numbers aren't meaningful, and you really must have meaningful data to make decisions and everything. So bookkeeping is key. Revenue growth, it shows you the growth in there, so you can look at the growth of your business in just revenue terms. Revenue per client, so that we always look at that as well. But and the revenue growth, that's something that we would look at in our business, and it's worth looking at for everybody as well. And sales, the number of sales that you have in a given period, the year, month. I would definitely look at it monthly, and then you can compare. And the profit. So if you realizing that you're not making a profit, you then will want to be looking at, why am I not making profit? Can I change certain things? Can I tweak things a few percentage? Or do I know I'm not going to make a profit now, but I'm going to make a profit next month, for whatever reason that might be. So enhancing the value of your business. So you must first sort of develop and implement a clear plan and document your organizational structure and roles within your business, because that's key. So if you need to understand what everyone's doing, and you also need to have that plan. If you have a plan, I think it's something like between 1% and 5% of people have a plan. And those people who have a plan are more successful with goals and plans. That's personal and business. So I'd advise having a plan. We do it every year for our businesses, like Nail Accountancy Services. We do ours in Feb. We do it after the self-assessment season. And we've already done it with my other business already. We did that in December. And so we have a plan every year, and then we look at it every quarter and relook at it. So it's definitely worth looking at that on a regular basis, but also creating it every year. Establishing cloud-based real-time report, if you haven't got that. QuickBooks and Xero you should have if you're with us. But definitely if you're not with us, look at that QuickBooks Xero. It's definitely worth having. Just make sure your bookkeeping's up to date. So implement a clear plan, document organizational structure and what. Now that I mentioned that as well, and real-time reporting. So also just review document systems and processes. So that's just to make sure that you know everything that is being documented and processed, so you can improve things as you go along, and also you understand what's actually happening within your business. We have something called Project Perfect. So whenever there's an issue, we will look at the issue, try and discuss it. Well, we will discuss it and then have a solution. And that might mean adding an extra step into our process. And these could be tiny little issues, tiny little things. Now, we're just looking for 1% changes all the time, just in anything we do in Naylor Accountancy Services to improve our services. So if anybody ever has any feedback, we want to hear it. If it's negative or positive, we prefer positive, but we want negative, because that's the only way we can improve as well on anything, because there could be something that we just missed. And that's how you should be as well. Look at your 1% changes that you can do. Now, reduce your reliance on owners. Now, the reason for that is for enhancing the business value. Is if you are wanting to sell your business, if it relies on you, the value of that business is not that great, because they need to replace you, and you might not be replaceable, because every business owner tends to be the best team member or employee. I don't use employee normally, I use team member, because I know you can't run a business without a team. So you want to be, and you're very difficult to replace. So what you want to do is create a structure and a business that can, if that's what you want to do. If you're a sole trader or you're not interested in that, that's absolutely fine. But if you're wanting to enhance the value of business to sell in the future, you need to be looking at yourself, taking out more, and then you can focus on things you want to, and also on the strategy of the business. That's what I've done in Naylor Accountancy Services and also intelligent outsourcing. So I'm operating at a different level in that, rather than an operational level. So it's definitely worth thinking about it on enhancing the value of your business. Identify and manage risk. Now that is key. So one thing you want to be doing is always looking at what your risks are and identify them. You may not be able to do that, so you can do a SWOT analysis. So just do that, which is strength, weaknesses, opportunities, threats, and then look at what those big issues are. And that's worth doing on an annual plan. We do that all the time, every year, just to we look at the risks all the time anyway, but that's when we really just start it from scratch every year, to make sure we're not missing anything. Because you don't want them to become big issues. And if they are big issues, if you've got a plan, an idea of it, you will actually be able to deal with it very quickly. So protect your assets. I'm just going to go through this briefly, and this isn't a full extensive version. But by being a limited company, you have limited personal liability which is great. So if anything happens to your business, you don't have to pay out money unless you do anything criminal, and then it becomes a criminal case. But normally there's no personal liability in a limited company unless there is something criminal. But that has never happened in any cases that we've had. But so it just means that if your business isn't in a great place, you have got limited liability, or if something happens that unforeseen. Directorship. So consider who should be directors of your company and which assets are held personally by directors. So just make sure you consider that under your protecting of your assets. Ensure that you have security over any money you lend to others. So if you are lending it as a business or even personally, make sure there's security on it. Otherwise, you may not get that money back. Ownership option of high value assets. So this is a very key thing. So if you have, and this is what I was sort of alluding to earlier, if you have rental, if you own a property, say for your business, say you own the office that you are using as your business premises for your business, and then your business also owns that premises, that property, it's not the best. What you are better doing is limiting liability, because if the business goes down, all your creditors will actually have access to that house, that property. So they'll be going for the property. So then you lost your property and your business. What you'd want to be doing is taking that property out of your business, putting it into another limited company, and having that limited company run separate as a separate legal entity, and then charging rent to your business. By doing that, then you've got segregation of the asset to your business. So if your business goes under, or you still have your property. If also you wanting to sell your business, you can sell your business and you can still have your property. So you can then just, otherwise you have to then take it out of the actual business, and then you obviously can charge rent to whoever you sell it to, or whoever then comes in if they don't use that property. So that's the real key asset one that we recommend to all of our clients. Terms of trade and credit policies. So just, yeah, I would, review the terms and trade of credit policy, and just sure you only provide credit to customers who are likely to pay you. So you don't want to be doing credit to clients who aren't going to be, but customers who are. Insurance. So ensure you take, you have sufficient protection. For example, the business interruption insurance, indemnity insurance. So we have to have indemnity insurance and health and safety insurance, and public liability insurance. So those are sort of the things to make sure you've got that in case there's any event that happens, to minimize any possibility. Some people have directors' salary type insurance as well, salary protection. Those are very expensive, so just be aware of that. But all of these are worth having if you are concerned about things. I'd always look at life insurance, guys. If you don't have life insurance as a business owner, you can put it through the business as a business expense. I do have that, but it's definitely worth having that. We do have an IFA that works with us, our partner. If you are interested in that sort of thing, let us know, and we can put you in touch with them. They can just let you know more about it. Financial planning. This is your future. So ensure that you undertake planning and manage your personal wealth outside of the business. You need to make sure you manage that. That could be pensions. In fact, if you are doing, we always recommend you do a pension through your business if you've got excess funds, or even if you can just do a small amount, because that's the great way, a tax efficient way. But make sure you've got planning, or whatever your finances are, to protect yourself. And then estate planning. Now, this is if something happens to you, and a power of attorney, your will, clear transfer of assets, especially of your business. I've had to do this with my wife because she wasn't very happy because I didn't have it all in place. She didn't really understand how the business would operate and everything if something happened to me. So I've had to do all that, and it's all in our wills and estate planning. I definitely recommend that as well. Again, IFA, I think we have people that can help on that. But if you've got a solicitor, anyone to speak to them, but there are other people out there that can help on that. This isn't an extensive list, by the way, guys, but it's one that we recommend. So every business, things that we've talked about, that's adopting better practice, the 3 essential tools. So we have actually got a webinar on this 3 essential tools in January, and I recommend you come to it if you're interested, because these are definitely, one is the annual business plan. It's perfect timing for January, when everybody's looking at the way forward and what they want to do in the new year. Annual forecast. It's great to have a forecast, because then you can see where you're going. On the annual forecast, I'm not going to go into too much detail, but we have done this for someone, and then they realized that there was a big business actually, but they were going to run out of cash, and they had to make lots of people redundant, and they saved that business. Unfortunately, it was sad that they had to do that, but they had to cut costs, everything straight away. Otherwise, they were actually going to run out of cash in the future, about 6 months down the line. It was coming in. So forecasts are very useful. Ongoing reporting and accountability. Now, this can be with a coach or your accountant, like us. So it's definitely worth having ongoing reporting, even if you just do it yourself from QuickBooks and Xero, but make sure you're accountable. Accountability is what actually makes things happen. So make sure you've got some accountability there. And knowing your numbers. So these are the basic practices. We've just done that. But knowing your numbers is the beginning. And it's a way to improve your business and through the numbers, basically, and understanding them. So next steps. So these are things to think about. So get started now. So basically, don't leave it. Yeah, I know it's coming up to Christmas. Have a look at it over Christmas. If you've got QuickBooks Zero, have a look at your numbers. Write down 3 things that you might want to take action on and become projects. And also issues. Don't worry about issues. Issues are there to be solved. This is how I see them. And they also can create projects from them. And problem is the opportunity to create a project. So it is an opportunity to improve things. Doing nothing is never an option. If you are insolvent, you must do something and must do something quick. Because it takes steps. It doesn't all happen overnight. You have to take time to do it. Now, how can we help? So there are things that we can do to help you. We can do business plans with you. We've got a client manager that can help with that. I'd recommend, if you are doing that, speak to us in the new year, because or now, and we can organize in the new year, but it's definitely worth doing that. But you might want to watch the 3 Essentials webinar first. Cash flow forecast, that's saved, like I say, one business massively. Board meetings. So we do offer board meetings. So if you want to have a meeting with one of our client managers, Andy, Michael, Philip, they can have those board meetings with you to go through your financials. And I know everybody's valuing that very much, that do that. They do it on a quarterly basis. You can do it monthly. Quarterly is fine to start off with. Management reports. It's worth doing management reports. Now, these don't have to be anything complicated. You can go in and just do it yourself, like from cloud accounting, your P&L and balance sheet. Just look at those on a monthly basis, or you can get us to help you with that as well. That's how we can help. We can help you with that. If you don't want us to help you do it as a service, just ask the client managers how you can produce those reports in QuickBooks or Xero, and they can show you how to do that, or one of the team members that you deal with all the time. Complimentary meeting. So we do a complimentary meeting. That would be with one of our client managers, and that will be to look at your P&L and everything, how we might be able to help you going forward, and just see if you're interested in anything there, and it might be useful on that. If you are doing an annual review with us, or go through your accounts, we do that as well, obviously. So we'll be looking at things then as well. But if you want a complimentary meeting, just let us know. Just email me or message me, and then we can actually book that in. It would be the new year now, guys, because we are closed between Christmas and New Year. So from Friday is our last day. Okay, thank you. I hope I have tried to go through that fairly quickly. I'm going to stop sharing now. So I hope you can see me. But there are... Can you see me now? I hope you can. But what I would say is with all this, it's never easy looking at all these numbers. But if you've got any questions, just do put them in. I have got a few questions that I'm just checking. Q&A. Just you can message me directly or here, but I've got some here that normally are asked, so I'm going to just put those in to start off with. So the first thing is, what's the difference? This is a thing that we get a lot. What is the difference between the accounts and accounts, the annual accounts and the accounts that can be produced throughout the year? So basically what I was saying was everything in QuickBooks and Xero, those are sort of profit and loss and balance sheet accounts. The ones at the end of the year, they are done to a standard that we have to do for the Companies Act. So we have to do that, the Companies Act 2005. So it has to be done to that standard. It has depreciation in it. It has a tax and splitting interest and principals of loans and prepayments. It does a lot more on that than so it actually breaks things out, and we make sure we check absolutely everything. Unless you do management reporting with us, we don't do the full check. Well, you wouldn't be doing it on a monthly basis or a quarterly basis. You do that at the end of the year, where you put in your annual accounts, basically historic as well, and regular management accounts give you up-to-date data. That's the other difference. So if you do management accounts, it will be up to date with accruals, and depreciation and things like that. So what difference between markup and margin? So yeah, no, we have spoken about gross margin, and that isn't quite the same. So it can be yes, the same as markup. So the answer is yes and no. Markup is the sort of the pound terms, and it's the same as the margin in that the difference between the cost price and the selling price, that's the markup. But the term of a percentage markup, like, and the margin, they're not quite the same. For example, if you sort of buy stock for £75 and sell it for £100, the markup is 33%, which is £100 over 75, but the margin is 25%, which is £25 profit divided by the sales price of £100, so 25 over 100. So that's just, I hope that's not confusing, but that is just one thing there. Any other questions? Will you send the presentation? I won't be, Bruce, I won't be sending this presentation slide, but there will be a video of it. And so if you want to relook at the video, and if you've got any questions on it, just let me know. And also Andy will be able to help, and I'll be able to help on it. So Bruce, just let me know on that as well. But definitely there will be the video, so it'll be on our YouTube channel, but you will be getting that as well, Bruce. So what other question do I have? So what happens if you are not able to pay off your director's loan? Oh, I have sort of spoken about this. I know, Bruce, you're all right with this one. But first we look at dividends. So we look at dividends, that's like a paper exercise. So we would do that in the background, and we would be letting you know in our annual review meeting, what's going on, because we'd make sure that we need to have enough retained earnings. So when we looked at the equity statement, that we had a loss there, so you wouldn't be able to do dividends there. So we'd be in a bit of trouble. You'd have to pay the 30-odd% tax out on that to HMRC. That does get repaid, like I say, but that's a pain. It really is a pain. We've had such a pain, especially when we did the acquisition. We had lots of that happening because it wasn't sorted out with directors that we took on. So it wasn't very easy to get the money back. And in one case, we weren't able to get it back because the time had been too long from when they paid it back to we've requested it back, because you have to do it by paper. And the problem with HMRC is they're totally overworked. There's not enough staff, basically, not team people there. Can you go into the business plan in more detail? Yeah, I will be, but I'll be doing that in the 3 essential tools, and that's in January. So do come on to that. So we're going into that on there. And it's a bit technical, so I'm not going to go into it properly there. So what I do, yeah, we will definitely be looking at that, and it's a good one in January, a really good webinar for you guys then to do. I really like that one. This one's a bit more, I find this tougher for me to do, so I apologize. I hope that you have gained something from it, but I know it's a lot of numbers. Where can I view the previous webinars? So Senna, you can do any previous webinars. You can actually view them on our Naylor Accountancy YouTube channel. So we have that there. We're going to be doing webinars every single month going forward, and they will be on there as well. We're going to be doing more content as well. So we may be doing more than just one. And what we're going to be looking at, we're looking at profit first. So that's a big project we're looking at. I'm going to be looking at over the holidays, creating it in our own businesses. And then we'll be looking at that going forward. It's definitely something that I'm excited by, but it helps everything that we're doing here on these webinars. It helps out because it just gives you, in my opinion, it gives business owners total clarity in what cash is theirs and what cash needs to go where. Now, I know, say, Bruce, you fine with that, with what we do, but there's even little things that we can extra. It might be able to just do something with you as well on that, but it's just worth looking at a few extra things. Always I recommend this to all of you if you've not got it. I know most of you probably do, but just have a VAT bank account. So an account, so you can just put your VAT in there, because that's what we see as the biggest killer for any of our business owners is not having the VAT. Okay, guys. If there's any more questions, put them in. Otherwise, I'm going to wish you a Merry Christmas. And thank you very much for joining me on this December. And have a great Christmas and Happy New Year. Thank you. Bye.